Let's talk about a very interesting subject, because I think a lot of people head outside, out of the country to find work and employment or otherwise, and they tend to come back. A lot of people tend to come back. So if you're looking to retire and moving from an NRI back to India, what do you need to bear in mind? How is it different from an Indian who has always worked in India and earned in India and retires here? To talk about this, I'm joined by Varun Fatehpuria. Varun, thanks so much for taking the time, and pleasure having you. So I think it's an interesting question to ask. What were your first thoughts?
No, absolutely, Alex. Firstly, thank you for having me back on the show. Right, and this is a concept that we are seeing increasingly becoming familiar with a lot of NRIs who had gone back outside for work and intending to come back to their home country for retirement. But there are obviously things that they need to keep in mind when they want to retire back to India from a return perspective, investments perspective, taxation perspective. So we can come to each one of them over the course of this show as to why each of them is important and what NRIs need to keep in mind if they are planning to retire in India in the next 10, 15, 20 years.
Okay, so let's start with the first thesis. Why would somebody come back to India? Of course, it's to a large extent to take care of family, or because they're attached to their hometown, for certain reasons like that. And we're assuming at this point, Varun, that they've earned more money outside India and they're coming back with a significant amount of money. So there's a repatriation that needs to take place of a lot of assets. So the first question is, how do you ensure that all of those assets come back, or do you continue to keep some assets where you were initially domiciled?
No, absolutely, Alex. I think keeping aside the personal reasons, I think there could be a multitude of reasons why anyone would want to come back to India. Firstly, obviously, being closer to their parents and a familiar social structure that they would be more comfortable with compared to their current country. Second would be relating to more about the cost of living expenses, right? So I think once people have accumulated an enough amount of corpus over their working years of 20 years, 30 years working outside, obviously they've built a certain amount of safety net, which would probably in most circumstances more than suffice for having a comfortable life back in India during the retirement phase of the next 20, 25 years compared to, let's say, in a high income country where the retirement basket may or may not suffice, right? So that could be one of the reasons also why someone who has worked outside may want to come back to India. The third, as you talked about repatriation, yes, there are certain technicalities that investors need to keep in mind when they want to repatriate their entire corpus back to India, because it has taxation implications. So let's say, for example, if you're already continuing to hold foreign currency deposits in an FCNR account, right? I think once that matures, then that needs to get converted into a resident savings account, and you need to repatriate it back completely once your taxation status also changes from a non-resident to resident. So there are obviously a lot of things that you need to keep in mind from a taxation perspective, the kind of investments that you are continuing to hold in your either an NRI account or an FCNR account, and transfer that back to a resident savings account, depending on what your taxation status is at the time of repatriation.
And this is something that is generally advisable if you're making the move permanently to complete over a period of 2 to 3 years, Varun?
Yes, absolutely. I think, let's say, Alex, just to point out, I think when you're planning to come back to India, your taxation status changes from a non-resident to something which is called as an RNOR, resident but not ordinarily resident. It sounds a bit paradoxical, but it has implications from a taxation perspective, because any of the income now which will accrue in India from this point in time will only be taxable in India, but any of your foreign income would not be taxable. But let's say you have made that move, you have continued to stay here for the next 2 to 3 years, then your taxation status again changes from RNOR to ROR, resident and ordinarily resident. In that case, your entire worldwide income will now be taxable in India. So this is a key point that you need to keep in mind, depending on when you are moving and the various phases that you have once you relocate, depending on what your taxation is at that specific point in time.
Okay. Now, the other aspects, couple of them that you have to bear in mind, and they're actually interlinked, is currency depreciation, which has continued to take place around 3.2% or thereabouts over the last 2 decades or so against the US dollar. The expectation is that that is likely to continue to take place, and that feeds into inflation as well. So inflation in India, because it's a growing economy and it's in a phase of rapid growth relative to other economies, will continue to have higher inflation. You have to account for both of them if you're talking about 20-25 years of retirement.
Yes, Alex. See, you have to keep in mind that when you're planning for a period of 20-25 years, right, at the time of your accumulation phases, you need to at least invest in instruments which can beat the nominal rate of return in India. Let's say if you're outside working in Singapore or in US, where the inflation rate is closer to 2 to 3%, your return expectations from your investments would not be so high. But let's say you're moving back to your country, inflation rate, as you pointed out, is 6 to 7%. You need to really think about where you're parking your money, because you cannot continue to grow either your USD fund or an SGD fund at 5-6%. You need to significantly increase that to 10-12% to just match with the pace of inflation that we have in our country. So that is with respect to how inflation actually makes you think about the kind of investments that you want to do, and it is important that you start planning for it today rather than leaving it at the closer to the date. And second is with respect to the depreciation, as you correctly pointed out, when we are thinking of repatriating our capital back to our country, the depreciation actually works in our favor. So instead of actually completely moving it at one go, if you can spread that over a 2 to 3 year period, then the depreciation of 3.5% will actually give you a slightly higher number compared to shifting it on day one completely. So both of things actually work in your favor that way.
Okay, to close out, how do you plan your investments? Because you're essentially going to be buying fresh, one would assume. Would you actually suggest buying in beforehand so that you don't have to do the heavy lifting when you do make the move? And once you do make the move, how do you structure your overall investment portfolio, because you have to beat inflation?
So our suggestion always is once you have some clarity on when you want to make that move, ideally that would be 7 to 10 years prior to your retirement, start aggressively investing at least in developed market equities. That could be India, that could be China, so that you are getting a nominal rate of return of 10 to 12%, which would be more than enough to actually beat the inflation. Continue to have some developed market exposure in the form of ETFs, whether in US, Europe, Singapore, to provide that international diversification, and keep that split anywhere between 60-40, 60 going towards developed market equities to get you that higher nominal rate of return. So over a 7 to 10 year period, assuming that you want to get that capital back in INR form, you have a certain amount of money that you could play around over a period of time. Second thing that you need to keep in mind is the withdrawal rate during the time of retirement. Because the inflation is higher, I think the safe withdrawal rate in the West is anywhere considered 3.5%. But given that you need to continue to meet your expenses over the 20-25 year period retirement, that inflation number, that withdrawal rate obviously goes higher to, let's say, 4.5-5%, just to keep up with the cost of purchases in our country. So that also needs to be accounted for, the withdrawal and the amount of money that you have at the time of retirement, so that you can glide through over your retirement period.
You know what we'll do next week is we'll have a targeted how to build a portfolio for retirement if you're an NRI. And this, I think, should hold you in good stead, even if you're not, and if you're a resident Indian. And maybe Varun will be amenable to coming back to discussing this. Varun, thanks so much for taking the time and for speaking to us.
Alex.
All right, that brings us to the end of this edition of Your Money Matters. Tell us what you think, give us ideas about what you'd like to hear about, and do stay tuned. Lots more coming up on NDTV Profit.